Ladies and gentlemen, good day, and welcome to Q1 FY26 Dixon Technologies earnings conference call hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Bhumika Nair from DAM Capital Advisors Limited. Thank you, and over to you, ma'am.
Yeah, good evening, everyone, and a warm welcome to the Q1 FY26 earnings call of Dixon Technologies. We have the management today being represented by Mr. Atul Lal, Vice Chairman and Managing Director, and Mr. Saurabh Gupta, Chief Financial Officer. At this point, I'll hand over the floor to Mr. Lal for his initial remarks, post which we'll open up the floor for Q&A. Thank you, and over to you, sir.
Thanks, Bhumika. Good evening, ladies and gentlemen. This is Atul Lal, and we also have on the call today our CFO, Saurabh Gupta.
Good evening, everybody.
Thank you very much for joining the earnings call for the quarter ended June 2025. We have begun financial year 26 with robust all-round operational and financial performance. Our diversified portfolio, strong customer relationship, healthy order book, operational excellence, and focus towards backward integration and creation of components ecosystem gives us confidence that we'll continue our stellar track record of consistent performance and scale to new heights over the coming years. To share with you the key highlights for the quarter, consolidated revenues for the quarter ended June 30, 2025 was 12,838 crores against 6,588 crores in the same period last year, growth of 95%. Consolidated EBITDA for the quarter was 484 crores against 256 crores in the same period last year, which is growth of 89%. Consolidated PAT for the quarter was 280 crores against 140 crores in the same period last year, which is growth of 100%. Guided by our underlying commitment to financial prudence, we continue to demonstrate high level of discipline in managing our working capital cycle, which stood at negative 4 days, along with a strong balance sheet with a net debt of negative 214 crores. We continue to deliver consistent improvement in our return ratios, with return on capital employed of 49.1% and return on equity of 33.9% as on June 30, 2025. This reflects our strength of our business model, and these ratios will continue to serve as fundamental benchmarks in assessing strategic investment opportunities and guiding capital allocation decisions and ensuring alignment with the long-term goal of generating sustainable value for our stakeholders. We continue to make strategic investments to expand our manufacturing capacities, enhance our manufacturing capabilities, and focus on deepening the component ecosystem, which will help us build a resilient and future-ready business. We will be filing our component PR applications for display module, camera modules, and precision components in next week or so. Now I'll share with you the business performance and insights of each of the segments. Mobile phones revenue for the quarter for mobile business was 11,663 crores, a growth of 125% year on year, an operating profit of 395 crores, which is a growth of 131%. Out of this, revenue for telecom, IT hardware, hearables and wearables was 1,410 crores, 247 crores and 175 crores respectively. We witnessed a strong momentum in the quarter with healthy volume growth across various smartphone brands. Order books for Q2 financial year 25-26 looks even stronger ahead of the festive season, and we expect volume growth of at least 15% quarter on quarter. Dixon remains the largest domestic manufacturer of mobile phones with high volume capabilities and best-in-class infrastructure. Construction of our 0.8 million square feet mobile manufacturing campus is progressing well in Noida, and for our anchor customers with much higher capacity, and is expected to be completed by March 26. Approvals are expected for our 74-26 joint venture with Longchair shortly, and PN3 appraisal process for our 51-49 joint venture with Vivo is advancing well, and also the application for our joint venture with HKC is advancing well. We have signed a binding term sheet for 51% stake in Q-Tech India for manufacture and supply of camera and fingerprint modules for the smartphones, and will be filing applications under the CSM scheme shortly. Tentative agreements pertaining to the transaction are expected to be closed in another couple of months, and we expect the financials to start consolidating from Q3 of the current financial year. Construction of a facility for display modules, in which we have a 74/26 JV with HKC for first phase is underway for smartphones and notebooks, with trials to be commenced from Q4 this fiscal and commencement of mass production by Q1 of next fiscal. We'll be filing the application for this under the ECMS scheme also in the next 7 to 10 days. Consumer electronics, that's LED TVs and refrigerators. Revenue for the quarter was 672 crores with operating profit and margin of 40% and 6% respectively. Out of this, the revenue for refrigerator business was 328 crores. LED TV, Q2 of this fiscal looks very promising, and we have a healthy order book ahead of the festive season. We have a strong interest from some new brands of our ODM solutions, and almost 72% of our sale would be from ODM solutions in LED TVs. We're actively working on increasing the capacities and enhancing capabilities for manufacturing for industrial, institutional, and automotive displays. Refrigerators, within 1 year of operation, we have been able to capture around 10% of the Indian market in direct cool category, and seeing the encouraging response from the brands, we are now expanding the capacity to 2 million from current 1.2 million at the existing facility in Greater Noida. We are also now foraying into the new products in cooling division like frost-free, side-by-side, mini bars, deep freezers, and busy coolers. The output look for 25-26 is very promising with healthy order book, and we are confident of achieving 50% growth this fiscal. With the capacity expansion and new product categories, the business is expected to contribute meaningfully in the next couple of years. Home appliances, the revenue for the quarter is 313 crores, operating profit of 36 crores with a growth of 13% year-on-year with an operating margin of 11.5%. Our construction for capacity expansion for FATL in Tirupati will be ready by August 25 to meet the increased order book of our customers. Launch of semi-automatic washing machine higher capacity categories of 16 and 18 kg has already been done, and product will be launched by Q3 of the current fiscal. We have also now partnered with Eureka Forbes for manufacturing of robo vacuum cleaners, which diversifies the product portfolio. We have already started working on project for front load washing machine and have appointed a very senior Korean expat to drive this project. Lighting, revenue for the quarter was 188 crores. Our 50/50 JV will signify that as Philips brand will commence the operation from first week of August 25 and expected to realize operating efficiencies through synergies, the addition of new product lines including premium indoor and professional lighting and potential export opportunities. We got a first pilot order from one of the top retail chains of US, which are expected to be executed in the current quarter and aim to scale up this opportunity into a sizable business in the upcoming quarters. We are continuing and focusing and investing in automation to further enhance the operational excellence. Telecom and networking products. This segment witnessed a strong growth with revenues of 1,410 crores, which is more than 250% growth. Home broadband penetration in India continues to grow at a very fast pace, and we've been continuously building up more capacities and enhancing our manufacturing capabilities for 5G FWA, that's fixed wireless access devices, for our anchor customers. We also have a very strong order book from our anchor customers on IPTV set-top boxes. In line with the backward integration strategy, we have already localized components including moldings and adapters and now focus on other critical parts with the objective of strengthening supply chain resilience, improving cost structures, and support margin expansion. We are in an advanced stage of discussion for a JV for a critical component for telecom devices. We see telecom segment as a multi-year growth opportunity, and we are actively working on non-CP products now. Laptops, tablets, and IT hardware products. Our dedicated IT hardware product manufacturing unit in Chennai has started mass production of laptops and AIOs for HP and Asus. Order book for Lenovo is picking up every month and expect a strong revenue growth in coming quarters. We are excited about the long-term opportunity for this segment. Our 60/40 JV is in Mentec, one of the world's top 5 PC ODMs for manufacturing of notebook PC products, servers, and desktop PCs expected to be operational by Q1 of next fiscal. We have signed a binding term sheet of of 74/26 JV with Chongqing UI for precision components for mechanicals and metal parts for existing customers for notebooks and further be extended to smartphone and various other product categories. We'll file for this category also our application under the ECMS scheme shortly. We're also pursuing potential partnership for components like SSD, memory modules, and power supply to leverage the IT hardware PLI scheme. Wearables and hearables, revenue for this segment was 175 crores for the quarter with healthy operating margin and very good ROC. We have strong order book in this business. We have also now added dash cams and smartwatches to our product portfolio with the existing customer, and we are also in discussion with new brands with increased focus on backward integration and localization. At Dixon Electronics, this JV with Exim achieved highest quarterly revenue of 144 crores with very healthy operating margin and high ROC. We have finalized a new manufacturing location at Chennai for meeting the increased order book for our anchor customer, which is expected to become operational by Q4 of this fiscal. So I would like to stop here, and me and Saurabh are there to address any questions. Thank you so much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask question may press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Siddharth from Norma Capital. Please go ahead.
Yes, sir. So first question is on this camera module JV. Can you share some more thoughts about how should we think about the ramp up here in terms of volume market share which they have, who are the key customers, and if as and when they come with us in a JV, how should the ramp up look over the next couple of years?
So QTech is one of the 5 largest camera module manufacturers globally. They have a running factory in India, and already in India they are supplying to all the major Android brands. That is Vivo, Oppo, Xiaomi, Motorola. They have a large market share there. Just to give you a thumb rule kind of a thing, in every camera there is almost, in every mobile, there is almost 3.2 camera modules going in. So the Indian market is around 475 million camera modules. Last year they did around 40 odd million camera modules. Dixon in-house consumption itself of camera modules is going to be almost in next 2 years reaching 180-90 million. So we want to ramp it up to that level, plus whatever we can sell to the in-house consumption, in-house manufacturing of the various brands. So that's the addressable market we are looking at. We feel that over the next 4 years, last year they've done a revenue of almost 1977 crores. We feel that over the next 4-5 years, this business is going to be somewhere around 5,000 crores.
Got it, sir. And how do you see the investments here for both the initial investment of the 51% stake and subsequent investments going ahead, and similar for the Chongqing JV, any numbers there in terms of investments and revenue ramp up you are looking at?
So there is some investment going into the purchase of shares from present owners, and this is almost around 400 odd crores.
Yeah.
Balance 150 odd crores is going to go for the capex use into the company, and this is required for the capacity expansion of deepening of manufacturing of what we plan to do. So this is the nature of transaction.
Got it, sir.
And in
Thank you.
the Chongqing UI, the contours are still being worked out.
The numbers are yet to be worked out, will be worked out in the next couple of months.
But we feel the investment there, the total project cost is going to be 100 odd crores.
Okay. Okay. So given these investments now for the year, how do you see the total CapEx and investment spent for the company? If you can just guide us broadly.
Yes, if you see, in first quarter, we made a CapEx of around 287 odd crores.
287 odd crores, and
I feel another 800 to 900 crores is going to go into this.
yeah, so combination of expansion capacities and also this
Acquisitions.
Q-Tech acquisition. I think so, yeah, by end of this year, we should be closing at a number of closer to, yeah, anywhere between 1150 to 1200 odd crores.
Total.
Yeah.
Got it, sir. So lastly, on the consumer electronics, we have seen a very sharp fall in the volumes or the revenues consistently. So, what is the outlook there? When does things start turning around, or do you think it may take some time before we do see any meaningful improvements here?
So undoubtedly, in the first quarter, we've had a significant miss on the television business, although the refrigerator business has done exceedingly well. In Q2, the order book looks good. We should be back to almost 800K in the Q2 of this business, and 72% of this business is through the ODM solutions.
Got it, sir. Thanks a lot. I'll come back in the team.
Thank you. The next question is from the line of Darshil Pandya from Finterest Capital. Please go ahead.
Hello, am I audible, sir?
Yeah, please.
Yes, sir. Good evening. Sir, my question was in similar lines with the earlier participant. I just wanted to understand the security surveillance system business and how are we planning to, cope up with the government's new targets of, just installing in the trains and now the CBSE boards. And all of what I've heard is that 80-85% of the business is all imported and it's just assembled. So wanted your clarity as to what we are doing in this business.
So we only have a minority stake of 6.5% in Other Infotech. Please appreciate our CCTV business has been merged into Other Infotech, and which we have 6.5% stake. So that's a limited interest in that business. And it's going through a different route of public markets, which I think will be a significant value creator for Dixon. So we are not running the business anymore. Yeah.
Okay. And as per your 2024 annual report, it shows that we have plans to scale this capacity from 12.25 million to 21 odd millions. So where are we standing today? We might need to understand.
In the CCTV business.
Yeah.
So no, as already explained, so last year we did a transaction where we sold our 50% stake to our JV partner, Aditya Infotech, and we have done this, and as part of the transaction, we have taken 6.5% in their branded entity, and that entity is now going for an IPO. So we are a minority shareholder, so we are no more running that business.
Okay.
Basically, yeah.
So basically, this will be under the shareholding tax. Got it.
This will reflect as an investment in the Dixon balance sheet here.
Correct. So are we not having any plans to,
Sir, I just request you to rejoin the queue, please.
I'm not asking new questions. Just if you can just let them answer once.
Okay, sir.
So we didn't get your question. Can you come?
So do we have also plans to, run this separately, or we want to be kind of investors in this Other Infotech and
the minority partners of Other Infotech.
Got it. All right. Thank you. I'll get back in the queue. Thank you.
Thank you. The next question is from the line of Aditya Bhartia from Investec. Please go ahead.
Hi, good evening, sir. So my first question is on good evening, sir. My first question is on the Longcheer JV. Earlier we were having just a contract with Longcheer. Now we are going the JV route. Just wanted to understand the rationale for that and how volumes are likely to be shaping up versus what our initial expectations were. That's the first question. And the second and related question is on some of the JVs. and arrangements that we are now having with Chinese companies, whether it's Longcheer or Vivo or QTech or HKC. If you could just kind of give us some indication about what the status of government approvals is. Are we seeing any challenges around that?
So Aditya, in Longcheer, it's one of the largest OEMs globally in the space of mobile and certain other IoT products. We are having a 74-26 JV. Our information is that we'll be getting the PN3 approval very shortly. Now, in the mobile space, they are a large player with a large customer base, and they're a large outsourcing partner of various global brands, which is even beyond Chinese brands. And this firms up our relationship and secures our business in also the post-PLI scenario. Further, it helps us in deepening the manufacturing because they have a huge strength in supply chain. And also, they are helping us in expanding the product portfolio beyond smartphones. Further, there is also a commitment of setting up a joint design center. So for us, strategically, it's a very important move in becoming a much larger and much deeper player in this whole ecosystem. The second JV application under PN3 that we applied for is for a display module with HKC. HKC is, one of the largest global fabs within top 5. And in phase 1, we're setting up a unit with a capacity of 2 million displays per month, which is going to be for mobiles, which is going to be expanded to 4 million. Also, we're setting up a line for 1.8 million of notebook displays. And also, these lines are fungible for automotive displays, both for two-wheelers and four-wheelers. We're looking at a business case for setting up a TV module display line. So we are expecting to make a capex over a period of time of almost $130 million. The factory of 400,000 square feet is under construction. It's going to be handed over to us, I think, in next 45 days or so. They'll start handing over. In this, the JV application is under approval. The PN3 is under approval. We are pursuing with the government. We feel that we should be able to get it in a couple of months. In any case, the execution of JV or execution of this project is not hinging on the PN3 approval. The project installation, the project implementation is carrying on parallelly. The third is a JV application under PN3 for our acquisition of 51% of the manufacturing arm of Vivo, and that's also under evaluation. That's going well. We feel that we should be getting it again in the next 3 days or so. And post that, the consolidation and execution will start happening. Among the fresh applications for QTech, we don't need a PN3 because the unit was set up before the PN3 notification came. It's going to be something similar to our acquisition of iSmartU. In the case of UI Chongqing, we are going to be filing a PN3 application. So, once the binding term sheet has been signed and the teams are going to be working, and we feel that we should be filing in the PN3 application in next 30 to 45 days.
Understood, sir. Understood. And just one last thing on lighting exports. If I heard you correctly, you spoke about some export orders from one of the US retail companies. If you could just throw some light on that and how we are looking at the lighting business after the JV with Signify.
So before answering to your question on exports, I'll touch upon that slightly later. Let me give you the business thesis behind the lighting joint venture. You see, please appreciate lighting globally and also the case in India, particularly the consumer-facing lighting. And in the domain in which Dixon operated, which was largely LED bulbs, downlighters, and tube lights, battens, there has been a huge deceleration in prices and also a huge commoditization. So that's the reason we went in for this joint venture, a 50-50 joint venture with Signify. So more volumes are going to come. More than that, what happens is that it shifts our manufacturing footprint to premiumization. The product portfolios being expanded into is largely on the premium side. And this new product portfolio, and we are working on hundreds of new products, because the combined strength of Signify R&D and Dixon R&D is working on that. Some of them are existing solutions, some of them are new solutions. It's going to be not only for Signify, but for all the other existing customers. Further, it helps us in accessing the global markets. So we are excited about it. We feel there's going to be a significant growth, and also this operating leverage. So one, it's going to be heading towards premiumization. Second, it's going to give us an operating leverage to manage our costs better. So that's the thesis on which we are working, and we feel that it's going to give us results. Now, on the export side, there is a large retail chain. I'm not in a position to share the name of it, which has placed on an order on us, which is a pilot order, mainly in the area of strips and ropes, strip and rope lighting, which is going to be executed in this quarter. We feel that this should scale up over a period of time.
Understood, sir. That's very helpful. Thank you.
Sir, thank you.
Thank you. The next question is from the line of Madhav from Fidelity. Please go ahead.
Yeah, thanks so much for your time. Just wanted to understand how the valuation was arrived at for the Q-Tech acquisition. So if the revenue is about 2,000 crores, I'm assuming 5-6% EBITDA margin, and if it's growing to like 5,000 crores in 4-5 years' time, just if you could help us understand how the valuation was arrived at about 1,000 crores for this entity.
Yeah, so basically, the revenues on 2,000 crores, they have an EBITDA margin of broadly 7-7.5%. So broadly at 150 crores of EBITDA and 72 crores kind of a PAT. This is the last reported numbers. So if you look at the valuation, the 550 odd crores.
15 times of PAT.
15 times of broadly PAT that we have given, or in terms of EV EBITDA, it will be closer to 9-10 times.
Okay. Now I'm just trying to understand, how does the valuation get arrived at, given where the sector trades at in India, and the growth is pretty strong, 2.5 times growth in sales in 4-5 years' time. So just trying to understand the valuation, Matt. Is it how does that get arrived at?
It's a negotiated valuation, and it's basically both the partners are bringing their own. We're bringing their own synergies on the table. So we bring in a large Android ecosystem. We bring a large customer access. They already have the technology, and so both the partners are bringing. So it's a negotiated kind of a deal. There is no specific way. It's more of a negotiated kind of a deal. We think that both partners can bring in their respective synergies over a period of time, and together we can make this business scalable from 2,000 odd crores to 5,000 crores. And also we feel confident that with more deepening of manufacturing happening in India, and also to take it, also by leveraging on this ECMS PLI scheme, this margins potentially, which is 7-7.5%, can go to 9-9.5% in the coming years.
Understood. And just the smartphone volumes, please, for Q1. Thank you.
Yes, the smartphone volumes for Q1 was almost 9.6 million. 9.6 million. 9.66 million.
9.6. And the feature phones?
Feature phones was closer to 5.73 million.
Okay. Thank you. Thanks.
Thank you. The next question is from the line of Piyush Khandelwal from Motilal Oswal. Please go ahead.
Thanks. Thank you, Atul sir and Saurabh. So just wanted to ask, do we have any plans to get into the bare PCB manufacturing as well? Because that might help us in getting more of backward integration as well.
So Piyush, as of now, we are not pursuing it. We were working on the strategic acquisition because, to be candid, we were working on a very tight timeline so that we can file the applications of ECMS and leverage the government policy framework. So as of now, no, but definitely we feel that PCBA is a very large opportunity. Now, the next phase of mine is to create a business resource and a strategy for pursuing that opportunity, undoubtedly.
Maybe something for industrials, automotive, PCBA kind of.
There's one domain we are going to aggressively pursue.
Okay. So just the reason why I'm asking this, because government is providing a subsidies anyways in this latest component PLI scheme. So we can anyways take an advantage of that. So that will be like much more lucrative as well. Apart from just PCBA, which you said is a very, very lucrative opportunity.
So as of now, Piyush, we are not pursuing at least the ECMS scheme for PCB, bare PCB.
So Piyush, you're focusing on other components, but yeah, we feel that other components.
You see, our sense, Piyush, is that there is a large surplus global capacity as far as PCB is concerned, bare PCB. Second, also, there is no duty arbitrage. It's an ITA1 category. So the government cannot create a duty arbitrage in this particular component. So the financial matrix is different. But I think it's a matter of perception, and each business was having its own view. And we have pursued the other parts of the component ecosystem.
Got it, sir. Got it. Thanks.
Thank you. The next question is from the line of Ankur from HDFC Life. Please go ahead.
Yeah. Hi, good afternoon, sir. Thanks as always for your time. Two questions on the cell phone business. One, obviously Q1 has been very strong, volume growth, top line growth again, extremely strong. And I think in one of your comments, you said you're looking at another 15% Q1Q growth as well, given the way order books are with you. So if you could just help us, what's driving that growth? Is it also scaling up of exports for one of your anchor clients in the US? Is it more domestic volumes, new customers? So just some more insights into what's driving that growth. And if I remember right, you said about 40 to 43 million annual numbers for the cell phone business. So are we broadly sticking to that? Yeah.
So our order book, Ankur, is looking good for the smartphones. As Saurabh just shared the number, we did around 9.6 odd million in the Q1.
Mm-hmm.
And the order book is, I think we should be somewhere at around 11 to 12 million in Q2.
Mm-hmm.
Now, this is a mix of better performance of our customers, both in domestic market and also a significant flip of our anchor customer for global markets. This is a combination of the Q2 looks good, and we are confident that our final numbers of 40 to 43 million we are going to hit.
Yeah, we are working
and
towards it.
Please appreciate all these numbers we are talking about without the Vivo share.
Yeah. Sure. Okay. And just a follow-up there, given that the PLI, obviously comes to end in FY26, and, our guidance, of course, is to get to 60 million next year. And I know this question may have been asked to you earlier as well, is, how do we both retain and take on more customers, right, given that the PLI will not be there? So are we cost competitive enough? I know customers could also be a little sticky given our relationship with ODMs and the kind of scale we have. But if you could just spend a minute here as well, the scenario you see post PLI at the moment. Yeah, thanks.
So it's a combination of primarily three factors, Ankur.
Mm-hmm.
One is our deepened relationship with the customer,
mm-hmm.
and our large scale which generates an operating leverage. Second is the nature of a relationship with the customer is bound through JVs. Please appreciate the relationship with Samsung brands and also Vivo is through a JV route.
Mm-hmm.
The third is our foray into backward integration of camera modules, of displays. Now these gives us a significant advantage
mm-hmm.
and gives us a competitive edge.
Mm-hmm.
So we have done the number crunching and we feel that we will be able to more than adequately compensate
mm-hmm.
for the PLI component. So that's what the strategy is.
All right. Great. Sounds good. Great. Thank you so much, Mr. Lal. All the best. Thanks.
Thank you.
Thank you. The next question is from the line of Vipro Srivastava from Phillip Capital. Please go ahead.
Hi, sir. Just a couple of questions. Firstly, sir, on the camera module expected revenue, currently Q-Tech is doing 2K crore revenue for 5 crore camera modules. Correct me if I heard it right, but I heard you said 20 crore camera modules expected. So if I just multiply it proportionately, revenue should be 8K crore, right? Or is it 5K crore?
So you see, what I was talking about, referring was to the addressable market. So the revenue that we have taken in our budget is a certain percentage of the addressable market.
Okay. So you are saying out of 20 crore, you will do some volume, and that's why 5K. Is that understanding correct?
That's right. That's right.
Okay. Got it, sir. And sir, secondly, just a quick follow-up on the minority interest, because correct me if my understanding is correct. What I feel is minority interest is primarily derived from iSmartu and the Airtel subsidiary. So both these segments have gone up QOQ. Still, minority interest has declined QOQ. So can you please explain where is the disconnect here?
Yeah. So basically, one, you're absolutely right. One is on account of iSmartu. Second is on account of the telecom JV with Airtel as a 49% partner, and also the Caliphonix, which is basically a JV with Imagine Marketing or for the both brand. So the last quarter, I think so we also had some numbers coming in from our AIL Dixon, which was basically sold out subsequently. So that is broadly a difference, and also so that is
mainly the AIL difference.
AIL difference. Yeah.
Got it, sir. Got it. And sir, lastly, the 15% QOQ volume growth expected, is it fair to assume that revenue growth will be in line or better than this?
Revenue growth should be in line. It should be in line.
Okay.
Yeah.
Thank you, sir.
Export revenues in Q2. So yeah, it can be slightly better than this compared to Q1.
Sure, sir. Thank you. Thanks, sir.
Thank you. The next question is from the line of Anupam Goswami from Cert Life. Please go ahead.
Hi, sir. Sir, overall, let's say non-mobile phones, where do you see the size of this growing in the next 3 years? And what are the categories to lead this?
So when you are looking at the non-mobile business, we feel that our telecom business in a year or so can touch a revenue of almost 5,000 crores. We feel that in a couple of years, our refrigerator business, because in phase 1, we're expanding our capacity from 1.2 to 2 million and then to 3 million, can be somewhere between 2 to 2,500 crores. Washing machine, we are further expanding the capacity from 3 odd million to 3.8 million. The current revenues of almost 1,200 crores can go up to 1,800, 2,000 crores. Lighting through a JV, we are confident that from 850, 900 odd crores can double to 2,000 crores. So these are the numbers. Similarly, with the wearable business, there is going to be an organic kind of a growth. The new vertical which we are pursuing is mainly the IT product, which we are really focusing up to ramp up. We feel that in a couple of years' time, that again revenue can be somewhere in the range of 3,500 crores.
Okay, got it, sir. Sir, another there was some...
That be largely captive, so that's going to help us in improving our blended margins.
Okay, sir. Got it. Sir, one more question is on, there has been reports and media news also on the Motorola sharing or spreading its own, distributing its own EMS manufacturing. So are we losing any share on Motorola or any other launcher or anywhere?
So Motorola has got another EMS, but please appreciate that almost 80% of Motorola's requirement, in fact more than that, is with us.
Okay, got it. Thank you, sir.
Thank you. The next question is from the line of Naushad Chaudhary from Aditya Birla Mutual Fund. Please go ahead.
Yeah, hi. Thanks for the opportunity. two questions, sir. First, on the we are doing we have multiple projects in hand. Many of them are new for us. So, just wanted to understand from a management bandwidth point of view, if you can, help us understand how are we positioned, what are the key hirings we have done in last 1 year, and what are the gaps, or is there any difficulty in terms of, fixing the requirement of the management?
So undoubtedly, we are on a significantly aggressive growth path. So talent acquisition is an ongoing process. We have recently hired a vice president of strategy and digital transformation. We have hired a vice president for our components business. We have hired an expat from Taiwan to head our display manufacturing and business. We have hired a Korean expat to head our R&D for washing machines and appliances. We have hired a vice president HR. So many hirings are on, but of course it has to be scaled up much more. So we are working hard on the talent acquisition, and I think today we are in a sweet spot wherein we are able to get the talent.
And second, on the cell phone business, just wanted to understand, does your export business give you better ASP versus domestic? And if that is the case, can the productivity per staff or straight to the margin of export business could be better than the domestic?
So ASP for export, which is largely at present of our anchor customer, is almost similar to a domestic ASP. But exports, the appreciate is a complex business, and there are some ramp-up requirements. Wherein we have to invest more in the organization. So the margin levels finally is going to be similar, but initially the costs are going to be more. But finally the margins are going to be similar.
All right, sir. All the best. Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask question. The next question is from the line of Abhishek Ghosh from DPS Mutual Fund. Please go ahead.
Hi, sir. Am I audible? Hello?
Yes, Abhishek.
Yeah. So thanks for the opportunity. Sir, just in terms of, if I broadly look at your FY27 mobile guidance of that 6.5 crores, your market shares will be fairly high at broadly 45-50% if we exclude some of the brands which typically don't outsource. In terms of the long-chair JV that you're kind of announcing, you think there could be upsides to that? And how should one look at the export mix as far as the FY27 mobile targets are concerned?
So, there will be a long share, will be an upside to that number that we are talking about. And exports, we feel in 26-27, like this year we feel the export, last year it was around 1,600 odd crore. We feel in the current year of 25-26 it should hit around 7,000 crore. We feel because we are working on another large export opportunity. I can't share the granular details as of now. We feel that this number of 7,000 crores can ramp up to almost 11,000 to 12,000 crores.
So basically, Abhishek, the way you should look at it is, though the number may be 65 million or 6.5 crores which you mentioned, but that would have a decent export element also. So if you exclude that, then our market share may not be that much as compared to the number that you just mentioned.
Got it. And does this JV also open up some of the export opportunities for you guys?
Which JV you are referring to, Abhishek?
So the long chair one which we kind of asked with that.
Long chair to start with would be largely domestic.
Initially it will be domestic, Abhishek, but over a long-term period, mid-term period, yes, it can open up opportunities.
Okay, great. And so the last question is in terms of the margin profile for the mobile segment, with the backward integration you are doing with the JV partnership and other things where from a 15-17% of bill of material to almost something like in excess of 35 to 40%, and PLI going away in some time, how should one, broadly look at the margin trend as far as the mobile is concerned? There'll be also an operating leverage factor also. So how should we look at it?
Yes, so broadly the maths that we have done, we think that in 27-28, and of course a large part of it will start reflecting in 26-27 when the PLI also goes away. In 26-27, we think we can expand the margins even after taking into account the PLI margin, which is our share of PLI margin going away. We can expand the margins by almost 120 to 130 bps in 26-27, and which should even be higher in 27-28 once it is completely ramped up and we have expansion of mobile displays. We have more TV and automotive displays coming in. So we think 27-28 there can be a further margin expansion as well.
Great, sir. Thank you so much for answering my question. I wish you all the best. Thank you.
Thank you. The next question is from the line of Neeraj Jain from BNP Paribas. Please go ahead.
Yeah, hi sir. Thank you for the opportunity. So my first question is on the Inventec JV. Just wanted to understand what kind of products we are working on under this JV, and are we, when we say that we will also be getting into the servers, so does that all include a part of the broader addressable market of overall servers imports is around $5 billion. So just wanted to get a better sense what exactly are we looking to cater to under this JV with Inventec?
So this is a 60-40 JV wherein we have 60% and Inventec is 40%. It's going to be for notebooks, it's going to be for AIOs, and also it's going to be for servers. Inventec is one of the topmost, within the top 5 global ODMs in the IT product space, and also they're going to help us with the backward integration play. So this JV of ours with Chongqing UI, that is a large vendor to Inventec and HP. Also, we are exploring the possibilities of SSD and memory modules in this JV. So this is the mandate for this JV.
Sure, sir. So this SSD and memory module would be with some other partner, right?
So we are evaluating that. Some of it, Inventec has an in-house capability.
Got it. And so second question on Longcheer JV. So just wanted to understand, do we have a similar kind of agreement that we have with Vivo JV, in which around 65 to 70% of their volumes in India are tied up under that JV? So how are we looking at a difference in the incremental volumes that might come when we go through a JV route?
So as I mentioned to you, to the earlier participant, when Abhishek was asking that question, so once the JV is formed, we feel that practically all Longcheer volumes are going to be with us, which is going to be a further upside.
So basically, Longcheer is a large ODM partner for a lot of mobile brands. So they have a very deep relationship with them. So we feel that once the JV is concluded and they also happen to be an equity partner in that, then those volumes can potentially be part of their JV.
Sure, sir. That's it from my side. Thank you and all the best.
Thank you. The next question is from the line of Girish from MS. Please go ahead.
Yes, sir. Thanks for the opportunity. Just a couple of questions, if I've missed, sorry. On the CapEx part, I wanted to understand the outlook for this year and next year for the core EMS business and the component across the 3 portions, which is display modules, which HKC, the CapEx that you're likely to do on camera modules with the new tie-ups and the peripheral tie-up. And then I had a follow-up.
Yes, so camera broadly we have mentioned, Girish, that we will be doing a CapEx. There will be a combination of buying out their, it's an acquisition, so it's a combination of buying out their existing shareholders and also putting some primary money in the company to meet the CapEx and also deepen the level of manufacturing. So camera and displays put together, we would be doing a capex closely to almost, I would say, 750 to 800 odd crores this year. And also some part, and broadly the other part of the capex, the 300-400 crores can be the expansion of capacities and other things.
And on the core EMS side, how much would be the capex that you would think this year?
So this number that Saurabh just mentioned includes that.
Yeah.
So 750 crores plus 300 crores, so 1,000 crore across all businesses.
Somewhere around 1,100 or 1,200 crores.
Okay. And sir, what is the current margin profile that you have for the camera module acquisition, and what are the working capital days, if you can help on that?
So the EBITDA margins are somewhere in the range of 6.5 to 7%.
And sir, yeah, sorry.
No, go ahead.
I was just inquiring this in context of tariffs because presently I believe there is a 10% import tariff that exists on camera modules, and margins of this entity are at 6.5-7%. So, what kind of, I mean, is there like a royalty fee that this company is paying to the parent, or how is the max working out for them? And you mentioned in one of the interviews to the media that you're looking to increase the margins. So just wanted to understand the levers to increase and how that will come through on the margin side, because previously on camera modules, I believe, and on all components, you've been talking about mid-teens number on margins, but this number is quite low. So just wanted to reconcile what value addition will happen to increase it versus what we were earlier thinking of mid-teens to begin with.
So the mid-teens,
for camera modules, we never mentioned it's going to be mid-teen. Please appreciate that when you are doing the manufacturing in India and to secure more orders, you have to share some advantage with the customer also. That's where it makes the business case. So we plan to invest to further deepen the manufacturing. And also there is going to be a PLI coming into this business through the ECMS route. So we are confident that the EBITDA margin in this business would come up to almost 8.5-9%.
Yeah, so it will be a combination, Girish, of operating leverage coming in on account of increased volumes of basically our customer access to them. Second, the PLI benefit as part of the ECMS scheme. Third is more deepening of manufacturing. So they are doing a particular manufacturing process, which once we put in money in the company, which also gets qualified for that ECMS application, ECMS committed capex. One, it deepens the level of manufacturing. So deepen, you are able to capture more value here, so which increase the margins, and then the operating leverage, and then the PLI benefit. So we feel confident that the 7.5% margin can potentially go to 9.5% margin over the next couple of years.
Okay. And last question was just around.
Sir, I just request you to follow back to you, please, for the follow-up question. Yeah. Thank you. The next question is from the line of Keyur Pandya from ICICI Life Insurance Company Limited. Please go ahead.
Thanks a lot, sir. Just two questions. So first, on the broad timelines of all these JVs, so Inventec, Chingtong, and HKC JV, and as well as QTech. So what kind of ramp up we should expect over the next 2 years, considering that they are relatively new category and it takes some time for setting up plants and approval as well. So how should we think about say commissioning and ramp up of these JVs? That is first question. Second, on the mobile export side, I mean, is there a business case except for US where there are some restrictions on Chinese manufacturing to say, make phones from India and export, which is a competitive versus China? Does that make any sense in terms of the commercial math? So that is second question.
So respond to this part of your question. QTech is a running factory. So once we are able to conclude the deal, which we feel should happen within the next 2.5 months, we'll start consolidating the results and then we'll start ramping up. As we have shared in the this deliberation, that finally we aspire to reach a revenue of 5,000 crores over the next 4 to 5 years. As far as the HKC display unit is concerned, the construction is on. We are targeting to do the trials and pilots in Q4 of the current fiscal, and the revenues would start getting booked in Q1 of 26-27. Finally, the aspiration is that we should be able to do 4 million units of mobile displays, 1.5 to 1.8 million units of notebook displays, and we feel that we should be able to do almost 2 to 2.5 million units of the automotive displays. That's the plan. The Inventec JV, we target to start in Q4 of the current fiscal or Q1 of the next fiscal. For the new JV of Chongqing, Yuhai, the plan that is still being drawn is going to take some time. As far as the Vivo JV is concerned, we're waiting for the PN3 approval, and then we'll conclude it.
And the second question on the export opportunity and
export. We have already started exporting to Africa, and we feel that we will be able to meet the cost targets. And this is a large opportunity that we're working upon with one of our anchor partners.
Okay, so okay. Thanks a lot, and all the best.
Thank you. The next question is from the line of Teena Virmani from Motilal Oswal Financial Services. Please go ahead.
And congrats for good set of numbers, sir. Sir, my question to some extent is already answered regarding the camera module and precision components. Just wanted to get some sense from you regarding the margin improvement that can start happening. Can it start getting reflected in the financials from FY27 first half or second half once the PLI goes away and simultaneously your display and camera module and precision components simultaneously quarter by quarter they can add up to the margin improvement?
So that's what we are working on, Tina. It's going to be slightly slow of enhancement of the blended margins through the component route in first half, but I think second half we are confident.
But something like cameras and displays would start to reflect in the margin. Something like the precision components may take some more time. Yeah, but effectively the full impact would start coming in second half of next financial year or somewhere after the first quarter.
Okay, so you are in discussions with the existing clients also to accept the camera module and the displays that you all would be manufacturing.
That's right. So team is.
See, our existing customers, the brands, are already using Q-Tech. So it has to be further. Okay.
Understood. And lastly, just a small question, and how is the scale-up expected from this Vivo JV? Like this 65 million volumes that you have mentioned, does it include Vivo volumes or this is not including Vivo volumes?
That includes the Vivo volumes. The large upside would come in from Vivo volumes, which would,
Vivo is doing it has almost 22% share in the Indian market, which is almost 30 to 35 million numbers. And 2/3 of that volume is going to be done in JV. So finally, when everything is consolidated, we expect that volume to be almost 18 to 20 million. That's how we are talking about, because in the current fiscal itself, we are targeting almost 42 million. And another 20 to 20 million is going to come from the Vivo bucket.
By this JV. But that may come maybe by end of FY26.
That's right.
Understood. Thank you, sir.
Thank you. The next question is from the line of Amber Singhania from Nippon Mutual Fund. Please go ahead.
Yeah, hi sir. Thanks for taking my question and congratulations on good set of numbers. Hello, am I audible?
Yeah. Thank you, Amber. Thank you.
Yeah. So just two questions from my side is, one, if you can help us understand what kind of volumes Longcheer do in India currently with the various brands. And second thing is, when we will be moving into the backward integration, how easy and difficult to get the approvals for various components, be it your display module, or I understand Q-Tech already has for camera module, but for the display and others, how easy and faster it will be to shift for our brands or the brands which we are making for these components?
So responding to the first part of your question, our estimate is that the Longcheer volumes in India would be somewhere around 25 million.
Okay.
And Q-Tech, we explained to you that most of the brands are already using Q-Tech.
Yeah.
As far as the display module is concerned, some of the brands are using HKC. And for other approvals, our China team, HKC's China team and our India team has already started working with the brand owners because this approval is required at the POC stage. So they are already on the job for getting those approvals done.
Okay. But by the time it will be operational, we are positive that it should be get approved by then.
So it's going to happen in phases, but we are confident it will be done.
So HKC happens to supply it to this Android brands, but every model is different. Yeah, so those teams will be working. So yes, it will happen in phases, but model by model it will keep happening.
Got it. And just one last question, if I may. In terms of margins, you mentioned about the Q-Tech 6-7% margin moving up to 9.5. Similarly, if you can help us understand what kind of normal margin we can expect in HKC or the display module as well as on the mechanics whenever they will be operational.
Mechanical, the numbers are yet to be worked out. It will be worked out a detailed business plan along with them on the opportunity side.
So I'm just intervening. Please be rest assured on the mechanicals for the laptops, the margins are going to be very robust.
It will also be in double digits.
Okay. And display is also double digits.
It's higher double digits, yeah.
Fine. Thank you. Thank you, sir, and all the best. Thank you.
Thank you. Ladies and gentlemen, in the interest of time, we'll take this as the last question. I would now hand the conference over to Ms. Bhumika for closing comments, and over to you, ma'am.
Yeah. On behalf of DAM Capital, I would like to thank all the participants and again, thank you very much to the management for giving us an opportunity to host the call. Thank you very much, sir, and wishing you all the very best. Any closing comments from your end?
No, thank you, Bhumika, and thanks to all the participants for being with us. And we've already shared our strategy, our journey, our way forward. So thanks for being our stakeholders and supporting us. Thank you so much.
Thank you, everybody. Thank you so much. Thank you. Thank you, Bhumika.
Thanks, Bhumika.
Thank you, sir.
Thank you. On behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.